Good morning. My name is Tony Zhao. I am a mortgage banker with Investors Bank in New York City. And today I'm going to talk to you about the entire mortgage process. Exciting, right? Just kidding. So before you start thinking of purchasing a home, I think one of the most crucial and most important things you should do is get yourself pre-approved. Now, a pre-approval is going to tell you what you're able to afford and how much you can spend. And a pre-approval should be a free process. Any bank, any lender can go and get you a pre-approval without charge anywhere. Starting 90 to 120 days prior to the process of getting a pre-approval is key. Now, what banks look for when they do a pre-approval, the first thing they do is they actually run your credit. So everybody knows somewhat of what their credit status is, right? You have myfico.com, American Express and other credit cards these days will give you your credit report and tell you the contents of your credit. Consumer credit and what banks use is commercial credit are rated very, very differently. So when a bank looks at your credit, they want to know that you have established credit, that you can pay your little credit cards or debts on time. Because imagine, we're going to give you a large sum of money. We want to know that you're able to keep up with the mortgage payments and that you're going to be responsible fiscally, because we certainly don't want you to be late or default on your mortgage. And there's two types of buyers, obviously, when you file your income. First, you have a W-2 employee, which is a lot of regular buyers, right? You have a regular job, you get a regular pay stub, and when a lender looks at your income, they're going to look at your pay stub, right? And they're going to go off of how much you gross. Here's an important number. The figure that banks will use to approve you and see how much you can qualify for is usually 45%. They take 45% of your gross, not your net, and that's how they calculate how much of a mortgage you can take out. Now, what's within that 45% range is the mortgage payment, how much the taxes are on the property you're about to buy. If it's a condo, they're going to figure in how much the common charges are and how much your homeowner's insurance is. And everything that's also on your credit report. So let's say if you have a $25 credit card, you have a car note for $200, that's going to be all inclusive of the $4,500 or 45%. And if you're self-employed, right, banks will require 2 years of self-employed tax returns. So if you're a 1099, you have a Schedule C. If you are an owner of a corporation, you have business returns. Now, I had a client once told me that, hey, Tony, I'm not going to have any issues qualifying for a mortgage because my business makes $1 million a year. I said, great. And when I got the tax returns, he was partially right. The guy did bring in about $1 million a year, but he wrote off $850,000 of it. So what banks are going to look at is they're going to look at line 37 of your tax return. That is called your adjusted gross income. That's all your profit after your deductions. And that's how we're going to qualify your loans. Because think about it. If you're self-employed, you usually file your return at the end of the year or the year after. So how is a bank supposed to come up with a figure on the health of your business? If you're self-employed and you're purchasing right now, something you should be able to start gathering is something called a profit and loss statement for 2017. Every bank, if you're self-employed, are going to ask for that. The profit and loss statement is going to tell us how your business did last year, and it will help us determine how much of a mortgage you're able to obtain. Assets. So there's something that came out in 2001. It's called the Patriot Act. And the US government actually enacted banks to kind of be monitoring funds for real estate transaction. So every bank, when they do a mortgage, are going to look at your bank statements for the last 60 days. And when they audit your bank statements, if they see any large deposits coming in, they want to know where that funds came from. It is very, very important. Sometimes by the time I get a mortgage application, I have cash deposits, I have money coming in from overseas, and you know what? Banks are not going to be able to use that. So they're going to look at 60 days of bank statements prior, and they want to know where every dollar that comes in, and they want to be able to source it. Gifts for a purchase is absolutely allowed, right? We're going to want to see where the funds are coming from. We're going to want something called a gift letter. Here's a very, very important thing. When you're getting money for a home, it has to be a blood relative. You can't get a gift from a friend. You can't get a gift from a neighbor. The money for a down payment used for a purchase transaction, if it's a gift, must come from family. That is very, very important. I'm going to talk about pre-approvals for a building. Did you know that 20% or more of buildings in Manhattan or in New York City are not lendable by banks? When I talk to a client, I usually tell them 60% of getting a mortgage is about the building that you're about to buy in. Isn't that crazy? You can have great credit, great income, lots of money in the bank, and if the bank does not like the building you're about to buy in, they're not going to lend to you. So why is that? I'll give you an example. So if a sponsor that owns a building, right, and they own more than 20% in a building, let's say all of a sudden they go belly up. What happens to that building? Financially, they can be ruined because that builder or sponsor is going to stop paying everything, including taxes, maintenance, everything related to the building. And think about this. A co-op or a condo is a human being. It's like a corporation. Every condo and co-op has tax returns. Yeah, they have to file tax returns. They have a financial statement, and they also have a yearly budget showing how much cash they have on reserve. So you certainly don't want to buy into a building that's not fiscally sound because you have monthly dues, and if the building's not fiscally sound, that's going to affect you later on because you can have something called an assessment that's going to hurt you as well. So I think a lot of this is self-explanatory, but believe it or not, I see a lot of these during the purchase process. Obviously, you have to pay your bills on time, right? Banks will do a credit check in the beginning of the process. That's going to tell us that you're a worthy borrower and that we know that you're probably going to pay us back on time. But banks will do a credit check. They do a soft pull credit check right before closing. So I've had clients who actually forgot to make some credit card payment bills, and that brings their credit score down from, let's say, a 720 to a 660. That's going to affect your rate, and if it goes down low enough, you can actually get declined for a mortgage. How does a bank know that you're a worthy borrower? When we do a process in the beginning, when we vet you, we're going to ask you to send us rent statements, right? We want to know that you pay your rent on time because that's a great indication of us that you're going to be paying us the mortgage monthly on time as well. So paying your rent on time is crucial because that's an indication for the lender that you're going to be paying the mortgages on time. Keep working. There is a rule. It's actually a federal congressional act. It's called ATR, the Ability to Repay Act. And the Ability to Repay Act says when you take out a mortgage, you have to be able to show the lender you have the ability to make that mortgage payment. Because guess what? Banks are lending you money from depositors like yourself. So we want to make sure that we're making good risks lending money because we're lending your money. That's very important. We have to keep that safety net. So right before closing, we will usually do something called a verification of employment. And I'll tell you something crazy. I've had clients who does not tell us that they quit their job, who they switched jobs. You know, always keep your lender, your loan officer, afloat of what is going on with your employment situation so that at the last minute, we do not call and say, hey, you know, John Smith has switched jobs 2 days prior to closing. Pay stubs. lenders want to look at your pay stubs because on your pay stub, it gives us the description of your liabilities. Did you take out a loan on your 401k? Did you do anything on your pay stub that's going to hurt us or hurt the mortgage process? And I think one of the most important things is keep asking the loan officer you're going to work with questions. Every bank in New York City that does New York City business has an approved building list. So when you put in an offer, right, aside from your pre-approval, you're going to want to make sure that the bank you're working with is able to lend in that building. Every bank in New York has an approved or declined list because every bank has vetted that specific building, and that's going to give us a good indication whether you're going to be able to get a mortgage in that building. So the don'ts. Don't buy large purchases prior to closing. As I said, right before closing, we will do a very soft credit check. And I'll tell you, I had a client once who was cleared for closing, had all his ducks in a row, was ready to close on a Friday. And then on Monday, we pulled his credit, and guess what? The guy bought an RV for $200,000. Well, that's obviously going to make a huge impact on how much your lending ability is. So what you don't want is to make large transactions. You don't want to close out credit cards because, believe it or not, if you close out a credit card, that's going to bring your score down. You don't want to make purchases that's going to affect your credit because, remember, that 45% threshold for debt-to-income ratio that banks look at, that's not something that we're able to negotiate and move around. That is a strict, hard 45%. And if your credit card or if you take out some type of debt that's going to bring that 45% up, it is something that is going to affect your closing. And in New York City, if you have a commitment that you've given to the sellers, and all of a sudden you're not able to close on that mortgage, you may lose your down payment. And nowhere in the country do you have to put down 10% for a down payment. So these are all very important things to make sure that you're able to keep your down payment and to close on your mortgage in time. Large cash infusions. I think that's my biggest nightmare. When I look at bank statements and I see a ton of deposits. So I had a client who we looked at his bank statements right before closing because the process goes and it takes a while. And we saw there was a deposit of $25,000. And we asked him, where'd you get that $25,000 cash infusion from? Well, he said, I wanted to cushion myself for closing costs. So I sold my Marvel comic book set at a convention. Well, I said, dude, that's going to be a big problem. If you can't source where the money comes from, we're not going to be able to use it. As a matter of fact, that could be a cause for declination. So we can issue a commitment, and banks will give you a commitment, but they have every right to take that commitment back. So these are all things that you need to understand, prepare for prior to closing, okay? The Patriot Act is a very, very tough act that makes banks, we want to know where every dollar that you're putting into your bank account, where the money is coming from for closing. So be very mindful. If you're going to do a transaction financially into a checking account, savings account, money that you're going to be using for the closing, talk to your loan officer. Closing cost. And I think this is very, very unique because nowhere in the country are closing costs as high as in New York City. There is a mansion tax of 1%. Anytime you buy a home over $1 million, whether it's a condo, a co-op, multifamily home, there's a 1% mansion tax of the sales price, okay? And I had a client literally signed a contract for $1 million, and I said, can you bring it down $1 so you can avoid the mansion tax? That's how big of a disparity there is. Co-op. Co-op closing costs are usually very low because what you're doing is you're buying into shares of a corporation, and you're not paying for title insurance, you're not paying for municipal searches, you're not paying for title insurance. You usually pay the tax on the sell side, which is called a flip tax. And banks usually have a small fee up front. You have to pay for your appraisal. And in New York City, you have to hire your own attorney when you're doing a purchase. And when you are buying into a condo, condos, I would say, try to figure the closing cost for anywhere between 3 to 6% of the sales price, right? In a condo, you have to pay something called mortgage insurance. Mortgage insurance is anywhere from 1.8 to 1.9% of the loan amount. If you're buying into a new development, usually you have to pay the seller's transfer tax, and that is 1.9% of the sales price. So if you're buying into a condo, obviously it's a lot more expensive, and banks are going to want you to have some reserves after closing. And thank you very much.
Thanks. All right. Thanks. So we've got, again, Slido is where you're going to ask these questions. I've seen a lot of them already starting to come in. Make sure you go to the right rooms. This is Financing 101. Tony's presentation is where you're going to want to ask these questions. So I'll sit here and we'll get through some of these questions for you. So one of the first ones actually is something that got me. The first time we bought a home was about, I guess, 15 years ago or so in Seattle. And I was on the phone with the bank, and they said, do you want to lock in this rate? And I said, well, what does that mean? And they told me what it meant, and I said, oh, great, let's do it. And then 2 weeks later, the prices of mortgages had gone down, and I called back, and I said, hey, I want to lock in this rate now. And that's not how the locking works, is it?
No. So you're certainly able to lock in a rate at any given time. And I think, personally, it's up to the loan officer to tell you when you should be able to lock. And New York City is so specific because co-ops probably can take 90 to 120 days before you actually close on a process. Banks usually offer something called a 90-day lock or a 60-day lock. So that's going to be very typical at most banks that you go to. But you technically do not have to lock when you start the process. You can do something called floating the rate. Right? You cannot lock, just kind of see where things are going. And at that time, you can consult the loan officer, and they'll tell you when you can actually lock the rate. And one thing, most people think that rates are based on the Fed fund rate. You hear on the news, Fed raises their rates, and you're thinking mortgages rates are going to go higher. Well, mortgage rates are actually tied to something called the 10-year Treasury bond. So if you go to Google Finance or Yahoo Finance and you look and track where the 10-year Treasury bond is, that's going to be the indication of rates, where rates are going to go, up or down. So my advice is you try to float, but the usual lock rate is 60 or 90. And once you lock in the rate, you can't really unlock it because the banks can't come to say, hey, rates are up. Can we unlock you and give you a higher rate? Right. So that's not really how it works.
And so the question about co-ops is, when do you think is the right time to lock in? Should we wait for the interview, get a good interview, get approval? That's when you start to lock and work on closing? Or, sort of what's your best advice for a co-op in the interview?
In an environment where rates are not too crazy like it is now, I think once you hear back from the management company that they're ready to interview you, that's the perfect time to lock in your rate. So that gives you 40 to 50 days before you can close on a mortgage, and I think that's probably the best time to lock in a rate.
Got it. How realistic is it to buy a place with less than 20% down these days in New York?
I think the market is softening. Typically you have to put down 20%. Anytime you put down less than 20% in New York City, you have to pay something called mortgage insurance. And a mortgage insurance, which is PMI, is a third-party carrier. So they're insuring you as an individual, and you're paying a premium for the bank to say, hey, look, we have so little equity in the house that if we go late or if we foreclose on the property, the mortgage insurance company is going to come in and pay the loss on the foreclosure. So there are some banks in New York City that are starting to light up, I guess, on the down payment. But in my opinion, anything in a jumbo market, anything over $729,000, it's going to be very difficult for you to put down less than 20%.
Got it. One of the questions is, I heard first-time owners can put down lower down payments and get grants, but is it helpful or worth it?
So think about grants as a whole. Grants are something that the city, the government organization, they're offering these for lower to moderate income tracts, areas. So think about New York City. Most of New York City is wealthier, higher income, upper level income. So I don't think you're going to see as many grants in New York City. Maybe in the outer boroughs, places that have a low to moderate census tract is where you're going to be able to put grants or see grants. And think about it. If you're a listing agent, you're in a co-op, you're in a condo, and you have a buyer that is putting down less than 20% or coming to you with a grant, most likely your opportunity of getting that property is not so high.
Got it. So the next question is, if I change jobs during the home search process, and so I guess this is maybe you've already gotten pre-approval, and you sort of, you think you have the right amount of money, but you're going to change jobs. Is that harmful to the mortgage process?
So it depends. Certainly you can change jobs, right? You can change jobs, but if you're going from a pay stub wage earner to a self-employed, that's going to affect you because banks are going to want to see 2 years of self-employed history to make a determination on how much you can borrow. Now, if you're going from a W-2 employee to another W-2 employee, then it should not affect the process at all, as long as you update the loan officer and tell them, hey, look, I switched from company A to company B, and as long as it's within the same line of work. Remember, most people switch jobs because it's higher paying. So that's usually very helpful on how much you qualify for. Unless you go from $80,000, now you're going backwards and take a $40,000 job, yes, that's going to improve your process, but typically switching jobs should not affect the approval process, as long as you let the lender know ahead of time.
Okay, can I get pre-approval from more than one bank?
Yes. As a matter of fact, a lot of people do that. The reason why you don't want to do that is every bank that pulls your credit might have a small effect on your credit score. So you go to 10 banks and you get 10 pre-approvals. Well, that means 10 credit pulls. So you're allotted a certain amount of credit pulls each month, right? That's your right as a U.S. citizen, as a homeowner, as anybody. And the credit system wants you to use them to pull credit. But if you have it pulled 5 to 10 times within a certain amount of time, that's going to bring down your score dramatically.
Okay, next question is, I live with a family member and I pay my rent in cash. How will that affect me when I'm getting pre-approval or getting approval?
I think that really depends on the lender. There are some banks who will be very strict. They want to see rent history. And if you don't have rent history, they will not give you a pre-approval. There's another way, which is sometimes a bank will do a verification of rent, meaning we'll send that family member a form, and that form will say how much the rent is, how long you've been paying it, so on and so forth. Also, if you can try to document it, banks will say, if you can show me bank statements for 12 months that you're withdrawing $1,000 a month from that specific account and your rent's $1,000, we possibly can match it up, and that will satisfy that condition.
Let's see, how do student loans affect buying a home?
Well, student loan we look at as it's a regular debt, right? Because student loan actually may help you purchase a home, because for some students, you may not have established credit. But a student loan, you've probably been paying for a while, and that actually helps your credit score. So in my opinion, I think student loans should not affect the process. It may actually help the process as long as you've been paying your student loans on time.
Okay, next question is, we've got a lot of our money in the stock market, and we plan to use it towards a down payment. When should we think about converting it into cash?
When we start the process on the mortgage approval end, we will use stock market funds. We'll use account statements from equities, because if you're buying a co-op, which is a majority of New York City, what people don't want to do is they want to sell their equity or sell their stock position so early in the game. And what if they do not get approved for that board? What if they do not get approved from the co-op? Now you've sold your stock position, you've incurred a capital gain on it, and now that money is just sitting there. So typically, a bank will use bank statements or account statements from a brokerage account, and we will allow you to sell it usually 15 days prior to closing. We want to be able to see that you have the liquidity and the proceeds from the stock market funds for the down payment.
Next question is, I'm on maternity leave. Congrats, Mom. Will a bank give me a mortgage?
Absolutely. So what we're going to do is we're going to look at how much you're earning. I think there's new regulation where we're going to want to know how much you're going to be earning after the fact. We want to know how much your maternity leave or your maternity pay is. But the answer to that is yes. We definitely will.
Great. If I'm getting a mortgage through one of the major banks, Chase, Citi, Wells, how much of the interest rate is negotiable? Do the bigger banks negotiate better or worse? You know, what do you find?
You know, in my opinion, I don't think banks will negotiate rate at all, right? Because banks are very regulated. So if they give you a lower rate than the next person coming a higher rate, then you're being unfair. And in my opinion, no matter what bank you're going to for a mortgage, the rate is the rate. It's based on your credit score. It's based on how much money you're putting down. They're not going to give a better rate for one person versus another because it's something that is frowned upon by regulators.
Next question is, do you recommend a pre-qualification if you're not 100% sure when or where you're going to buy?
Well, there's a big difference between a pre-qualification and a pre-approval. And most real estate agents that I know won't really accept a pre-qualification. Pre-qualification is just a very simple credit check, just a brief scenario of how much you make. So it's not very specific. As a matter of fact, I don't remember issuing a pre-qualification or seeing a pre-qualification in the last year.
Okay.
And the pre-approval actually lasts 90 to 120 days, and they can usually issue a new one without repulling credit. So it's really just something for your foundation for you to know how much you can spend and how much you can afford.
So we have someone asking about the challenges of buying in a sponsor building. I think you alluded to it earlier of sort of, if it's the sponsor owns more than 20%, it might be a building that's not loanable. Is that sort of is that what you're looking for in the sponsors? Are there any other kind of gotchas to buying in a sponsor building?
Yeah, so every co-op and condo has something called a co-op and condo questionnaire, right? When a bank starts the process, they're going to contact the management company for these buildings, and they're going to get this condo questionnaire answered. And the condo questionnaire is sort of the report card for the building. And one of the first things we look at is if the sponsor owns a certain amount of the building, most banks will not lend to it, and the magic number is usually anywhere from 20 to 25%. If the sponsor owns 20 or 25% of the building or more, if it's an established building, banks will not touch it, no matter how great your credentials are. So you'll see on StreetEasy sometimes a listing that says cash only. That's because they know that banks won't lend in it because the sponsor owns a certain amount, and the sponsor needs to sell some of the units before they can actually, put it to the market or have regular banks lend to it. But if it's a co-op, sometimes it could be good because their sponsor units, if a sponsor is selling you a unit from a co-op, usually you don't have that board interview, and that closing time is pretty quick, within 30 days.
Is there a website where we can compare the mortgage rates from a lot of lenders?
Everybody is very different. It's like a fingerprint, right? So for a bank to say, hey, we're definitely going to commit to you and give you a 4%, 4 1/8, 4 1/4, it's not going to be accurate. So unless a lender pulls your credit, looks at the building, looks at your financials, and know how much money you're putting down, they're not really going to be able to give you an accurate quote. And most of what you see online is what I call teaser rates. It's for somebody with perfect credit buying in a non-condo co-op building, putting down 40%. So they want you to call them and say, hey, look, call me because we have the best rate. So that's not going to be accurate.
Great, we've got time for one more question, and so I think this is a kind of an interesting one. At what age does it not make sense to purchase in New York City anymore?
There are very strict rules and regulations that banks have to follow. You could be 90 years old and come to us and get a 30-year fix, and we must issue it because it's age discrimination, right? So we've done loans for 70, 75-year-old folks, and the reason why they take out a 30-year fix because It's amortized over 30 years and has the lowest payment. Doesn't mean that they're going to be around for 30 years to pay it, but we know that it gives them the lowest payment. And regardless of age, if you have the income, if you have the credit and you have the funds, and you buy in the right building, we will lend to you.
Awesome. Thank you so much. Tony is so knowledgeable.
Thank you.